I am curious about why you think that the longer-term growth trajectory is going to matter more than inflation at a time where the Fed has said this is a dual mandate and they very much intend to bring inflation back down to 2%.
Yeah, hi, Lisa, and good to be back. Thank you very much. Obviously, the two are interlinked, right? Ultimately, all of the models that sit behind modern central bank thinking tell you that there is some linkage between growth relative to potential, what that means for the labour market, and ultimately where inflation pressures will be over the policy horizon. So looking at inflation and jobs today is telling you a little more about what was happening in the economy yesterday. So when we see the most real-time stats that try and give us an indication of where the economy is heading with respect to broad growth, that has or should have some signal value for where those key metrics, jobs and inflation, will be in the future. So you can't really disentangle the two unless, and that's where Jim Bianco's definition of stagflation is interesting, unless you get an utter breakdown of the Phillips curve type relationship. And actually, stagflation was the description used to describe that situation when it happened in the 70s. And the reason I say nobody wants that is because there are lots of macro environments which are either good for bonds or good for equities. In a stagflation world, it is good for absolutely nothing.
And when you talk about the breakdown of the Phillips curve, it raises this question. All morning we've been talking about industrial policy. We've been talking about the potential for government spending as well as tariffs and blocking off traditional trade routes. Could that in and of itself create a more inflationary pressure than maybe the labor market dynamic would otherwise suggest?
Yes. I mean, the historical analogue for that sort of protectionist international trade policy very much goes back to Smoot-Hawley and tariffs, which did create significant problems many years ago. I think deglobalization, just generally, a lot of people would suggest that is a secular inflationary force because it's really the flip side of the global push to outsource manufacturing to the lowest marginal cost region of production, and that has seen the price of these manufactured goods declining pretty steadily over the last 30 years. So absolutely industrial policy will play a part. I think the extent of it, the time horizon over which it occurs is relevant because to me the question is it an inflationary process or do we see a step change in the price level which would be different from the point of view of what we experience in the economy but also what it would mean for monetary policy?
How are you positioning in terms of how this shakes out and where the Fed's reaction function really is in terms of sticky inflation, even with growth that is clearly souring and consumers that are clearly cooling some of their spending?
Yeah, I mean, it won't surprise you too much, Lisa, to hear that I'm on the slightly miserable side of the outlook. That I still believe that we are in an end of cycle dynamic. I'm not a huge fan of the word sticky. It's become, I think, a bit overused. There's a difference between the speed with which disinflationary pressures feed through into various aspects of the consumer price basket and genuinely sticky inflation. I think sticky historically is a word which was more applied to prices. Prices and wages tend to be sticky. That's not the same as sticky inflation. If prices and wages don't change, then inflation will tend to zero. So I think one of the reasons that we haven't seen a really rapid disinflation is because actually economies have held up better than a lot of people, myself included, thought they would. All that we've really seen is a global supply shock that has seen inflation rise and then the flip side of that inflation come back down. I think as and when, as I expect we will, we see the economy slowing more broadly and we see more significant softening of the labour market, that's when we'll start to see the more cyclical disinflationary pressures. So I still think we're in a world where yields look attractive, duration is attractive. The timing of that's going to be quite difficult. So we are, happy to lean into weakness in the bond market and increase our duration position as we look further into the future and expect the end of cycle to hit more significantly.
Speaking on the slightly miserable side of things, I'm here in Washington, D.C. to host a panel having to do with the deficit and the fiscal overhang of debt. And this has raised a lot of hand-wringing and, the deficit concerns about the potential for rates to go up materially higher than you would expect based on inflation and even Fed's rate setting. Do you buy into that idea that we're going to see some sort of bond market disruption in response to profligate spending that doesn't seem to be ending anytime soon?
No, I mean, it is one of those those concerns which is out there. I think the problem is that politicians to a pretty significant degree have learnt the wrong lessons, have been given comfort which is not necessarily something that they should or could rely on far into the future. Obviously, central banks have played a part. They've grown their balance sheets significantly in recent years, and that obviously has taken duration out of the market. That's allowed governments to run deficits which are, much higher than we'd expect given the stage of the cycle. And we saw in the UK that if you push too far, you can just reach that tipping point where other dynamics kick in and things start to look really messy really quickly. The flip side, obviously, is Japan has been apparently on the precipice of that situation for 30 years, and they've never quite reached that tipping point. So it's definitely a risk. It does concern me that there is sort of bipartisan support for having no real fiscal discipline whatsoever. But I suspect that, it's the economy stupid. The economic forces and pressures will ultimately tell for the bond market. And that means that, yes, we're likely to see supply being a constant. But I think, again, as other cyclical assets become less attractive because of how expensive they are and the deterioration in the economic outlook, that should improve the demand picture for bonds commensurately.